What's going on, everyone? This is Rob from Rob Invest coming at you with another video. Today we're going to talk about 3 covered call ETFs that's going to benefit from the new rate cuts. Before we get to the video, I am not a financial advisor. This video is for entertainment and educational purposes, so please do your own due diligence. So we just went through a rate cut and the stock market has gone absolutely crazy in a good way. We are also seeing stocks go up to an all-time high, so it's reaching a new record. It's been a pretty good week for the market. To these 3 ETFs. Now the first ETF, covered call ETF, is IYRI. Now if you guys don't know what this ETF is, it is a covered call ETF. It pays anywhere from 10 to 12% yield. It does cover calls on the REITs index fund. How would this benefit this covered call ETF? Well, if you look at real estate, what do you guys think about? We think about apartments, we think about houses, we think about land, we think about office buildings, etc. What do we do if we want to purchase an apartment building or a house or some land? We take out a loan or a line of credit, because the majority of people do not have 50, 100, 500, even millions of dollars sitting around just to buy a piece of land or a property or apartment building or even a house. How does this benefit real estate? When you borrow money to get a mortgage, the interest rate is lower. So what does that mean? Over a 10, 20, 30, 40 year period, you're going to pay a lot less in interest. Also, when the interest rates are lower, the demand for real estate is higher. But when interest rates rise, then that's when the demand goes lower, because borrowing costs are going to be a lot higher over time. Let's do an example of a rental property. Even if you buy a rental property and put a tenant in it, you're still going to have to pay the interest. Even though the tenant is paying down your mortgage, you're still going to be hit with that interest bill. The more interest that you're going to have to pay, the less profits you're going to receive every month and every year. So when rates get lower and lower, then your mortgage interest will be lower and lower, which means you're going to have more money in your pocket by the end of the month and at the end of the year. 2, IWMY or IWMI. Now we're only going to talk about IWMI because I think that's a better covered call ETF. IWMI, let's do an overview, is a covered call ETF. It is also managed by Neos Investments. It pays anywhere from 14 to 15% distribution yield per year, and it does cover calls on the Russell 2000. Russell 2000 consists of 2,000 small cap companies. So since the Russell 2000 consists of small cap stocks, they're not profitable, they don't generate enough cash flow, they don't have enough revenue to grow their business. So they have to rely on loans or lines of credits to get their business going. They may use the borrowed funds to buy a building or rent it, or buy machinery, or pay for employees, for advertising, for maintenance and repairs, etc. If the interest rates are too high, borrowing becomes very expensive. And that's severely going to reduce the profit that these small cap companies are going to make. I mean, a lot of these companies are not making profit. So if you're just borrowing at a higher rate, it's just going to make things worse. All right, third and final ETF that's going to benefit from rate cuts is QQQI. I'm not going to go over QQQI in this video. I have 2 videos that goes over QQQI, so if you want to watch those videos, you guys are more than welcome to. So how does QQQI benefit from rate cuts? QQQI owns the underlying QQQ. QQQ is technology heavy. How does this benefit this ETF? Better financial flexibility. That means these companies can hire more people. Also, when interest rates are lower, capital increases. So the lower the interest rates, the higher the evaluations and the more the company can grow. These companies can also fund their operations. It could be research and development. It could be expansion. It could be, like I said, hiring more people. It could be testing out a new product. Just anything that requires money, they'll be able to do it cheaply and more efficiently, and they might be able to get, better testing, better products, better services, more educated employees if the borrowing amount of money is cheaper. That's all I have for you guys. If you guys found this video helpful and informative, please like, share, and subscribe. Are you a holder in one of the ETFs that I mentioned? Put it in the comment section. Rate cuts. Let me know if you think they're going to go down some more or do you think they're going to stay the same. Alright guys, that's all I have for you. See you in the next video.